Hello, my name is Nick Griffin and I'm the CIO here at Munro Partners, and welcome to the 2019 September quarter performance update. Look, we prepare these videos to provide transparency to our clients into the performance of the Munro Global Growth Fund. What went right, what went wrong, and how are we positioned for the months ahead. Look, we appreciate the opportunity to look after your money, and our goal here is to provide you with some insight as to how we do it. So moving to the first slide, what we're showing you here is the performance of the various equity market indices around the world in local currency on the left, and the performance of the MSCI World Index in local currency on the right, with FX gains next to it, and then the fund next to that under the same metrics. And look, what you'll see on this slide, it was a fairly mixed quarter for global equity markets, and a somewhat difficult quarter for the fund. Global markets on the whole were positive, but the weakening Aussie dollar was by far the largest contributor to index performance. Comparatively, the fund made small losses at the equity level and did not gain as much on the FX, as the fund was on average just over 50% hedged back to Aussie dollars over the quarter. Combined, this resulted into a small absolute loss for the quarter, and also a fairly large relative drag versus the index over the quarter. So on this next slide, we're showing you just the fund attribution now by its constituents, being long equities, short equities, FX gains, and our put option hedging, which we otherwise see as insurance. And here you can see again the biggest gainer for the fund over the quarter was again that foreign exchange. The unhedged portion of the fund benefited from the falling Aussie dollar. Elsewhere, we made losses on some of our long equity positions and small gains on some of our short equity positions. And our option hedging was actually negative for quarter, as markets ultimately stayed positive, albeit on a fairly volatile path throughout the quarter. On this next slide, we're showing you the same attribution by region and by stock. And the key thing to note here is the performance of some of our higher growth and Asian focused names that really bore the brunt of the large equity rotation that we saw in the quarter away from growth equities. Conversely, some of our more defensive positions and larger cap names countered those losses. Look, also it's worth flagging here that no doubt you've read the news surrounding the large sell-off in high growth names and recent IPOs in the US markets, whether it's Uber, Lyft, WeWork or Peloton. Look, from our point of view, while the relative numbers here are a little disappointing, at the absolute level, we're happy to report no major calamities here. And in a broad sense, we've largely avoided being sucked into this more speculative part of the market over the last 12 months, and consequently weren't there as it unwound over the last quarter. On this last performance slide, we're showing you the fund since inception and versus the MSCI World Index, with a range of metrics alongside that. The key thing to note here is that Munro Global Growth Fund is an absolute return fund. It's not a relative return fund. We put the index there for your reference, but the main goal of the fund is to deliver you positive risk-adjusted returns through the cycle. And you can see that in the 3 years we've been running the fund, we've achieved double-digit absolute returns per annum since we started. And consequently, we feel we're achieving that target. That said, many of you will also notice that we've actually achieved this with 2 very good first years in the fund and a somewhat lackluster last 12 months. And so in these next few slides, I'm going to address why that's the case before talking about how we're positioned for the future. So on this next slide, I'm showing you the net and gross exposure of the fund on the left-hand side, both equity exposure and gross equity exposure. And on the right, I'm showing you the performance of the fund versus the MSCI hedged and unhedged index over the last 3 years. And on the left, you'll see for the first 2 years, we actually held net exposure relatively high, just under 80%, and enjoyed strong absolute and relative returns on the right-hand side. However, by October last year, the fund needed to move into capital preservation mode. We lowered exposure aggressively, partly due to us observing our risk controls and also partly due to the option hedging that I referred to earlier, that actually exploded in value in the fourth quarter. And if you look on the right-hand side, you'll see that it enabled us to provide capital protection versus the market. The fund did not fall as much in the fourth quarter, but it also meant the fund missed out on much of the upside as markets rebounded aggressively in the first quarter. And even since then, market volatility has made it difficult for the fund to return to a fully invested position. The second main issue we've had is mainly around the currency. Look, as an absolute return fund, we've been reluctant to fully unhedge our Aussie dollar exposure since the day we started the fund. We obviously see it as a source of making fund, but it's also a great way to lose money as the currency rises. And as an absolute return fund, we use this hedging for capital preservation. Consequently, we've run the fund at roughly 50% Aussie dollar and 50% US dollar exposure since inception. And with the currency stable for the first 2 years, as you can see on the right, this wasn't an issue versus the index. But over the last 12 months, while we've made money from the currency falling, it has caused fairly significant drag, relative drag versus the index. And you can see that by the two indexes I'm showing you on the right, as the unhedged index goes past us, but the hedge index doesn't. Look, over the long run, we'd expect this to even out. I've been running international equities now for 15 years. When I started in the business, the Aussie dollar was 70 cents and it went all the way to $1.10. And it created a huge absolute headwind. The Aussie dollar is now below 70 cents and the RBA seems determined to make it go lower, creating a huge tailwind. But ultimately, we'd expect this to even out over time. The last thing we wanted to flag on this next slide was the increasingly narrow nature of the market over the last 12 months. On this slide, I'm showing you the US S&P 500 over the last 12 months at the index level and the Russell 2000, which is the next 2,000 companies below the 500 over the last 12 months. And if you look at your slide, you'll see two things. Firstly, when you strip out the currency, the market really has gone nowhere, even at the S&P level in the last 12 months. And secondly, you'll see that smaller cap stocks have been significantly worse than that. And this divergence that you can see in the US market is really the flight to safety trade that we've been seeing all year. It's a defensive trade that's helped us in some parts of the portfolio, but it's ultimately meant we haven't been rewarded from any of the emerging growth names over the last 12 months like we were in the previous 2 years. The fund has achieved its target since inception. It was up last calendar year, it's up this calendar year. And look, while I understand relative underperformance is a frustration for you and for us, look, we're actually here to deliver meaningful positive risk-adjusted returns over a 3 to 5 year cycle. We've done that in our first 3 years. We have a track record that proves it can be done, and it's just a matter of being patient and letting the 3 to 5 year horizon we target play out. And look, so just moving to this next slide on the outlook. So why have we remained somewhat conservative throughout 2019? Look, it's mainly a function of the slowing economy. And here I'm showing you the PMIs, or the Purchasing Manager Index, of all the major regions throughout 2019. And as you can see, they continue to point to a bleak and slowing economic environment, not only in Europe and the rest in China, but also now in the US. And this is probably going to continue to equal slower earnings. Earnings will continue to be downgraded. On the next slide, we're actually showing you that this has been masked by falling interest rates. So the falling risk-free rate has allowed equities to hold up through this period, mainly through that defensive trade that I talked about earlier. And if you look at where the equity risk premium in, it's actually now still as low as it was in January, which has ultimately held up the market. Looking ahead, we still see risks to the market outlook. Earnings still need to be adjusted lower. It looks like central banks are still going to need to do more to ignite growth. A trade deal would be helpful. And we'd also like to see some of these IPOs slow down and some of these poor business models allowed to grow broke. But ultimately, this is a distribution process. The market's been going through this for 12 months now, but at some point the volatility will subside. At some point the bargains will become apparent, allowing them to be bought. And as I said earlier, this all just requires just a little bit more patience. So finally, how are we positioned considering that outlook? Look, really somewhat similar to how we've been for most of the year, somewhat with a foot in both camps. Exposure is roughly 75 to 80%, but we are still running put options underneath should volatility increase. But on the next slide is we're showing you how we really look at it, by areas of interest. This is actually what's really going to drive returns going forward. Here we are showing you the key areas of interest or themes we want to be exposed to. The weight for the fund along the bottom, the number of holdings on the right-hand side, and an indicative position. And look, over the last 12 months, these areas have really evolved towards the true non-economically sensitive areas of our universe. Digital payments has snuck to the top, as we've added some US merchant acquirers in the US. Digital enterprise, innovative health, food revolution, e-commerce, and internet disruption have all remained roughly the same over the last 12 months. And really our new investments are really focused on high performance computing and 5G infrastructure in the connectivity bucket here along the bottom. Look, lastly, we would flag in all these areas we see strong structural earnings growth in the years ahead, despite the economic noise and despite the volatility. And ultimately, we expect these companies to follow these earnings growth in the future and help us achieve our goals over the longer term. And look, I would encourage you to follow this video with our next one, where we talk about the emergence of infrastructure as a service in the cloud computing market, how we've benefited from this over the last 3 years and how we hope to continue to benefit from it in the months and years ahead. Thanks very much for listening, and see you next time.